Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Lithium Americas stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Lithium Americas has two lithium mining projects, one in Argentina and one in Nevada. The company has not started production on either mine yet, although it is likely to start production next year on both projects. The total expenses for the Argentina mine are $641 million. Annual EBITDA is $308 million. The life of the project is 40 years. This project has been in development since 2009. This is a picture of an evaporation pond from their website. LAC uses pumps to extract brine to the top of the water. They line the top of the water with a polymer-based material to remove the water so they can scoop up the brine. The sun helps evaporate the water, but if it rains, the process will be delayed. But the rainfall is usually limited in places where this process is used. Once the water evaporates, then what's remaining is the deposits of lithium, boron, and other salts. The initial cost of the Nevada project is $1 billion. Then $581 million for phase 1. The life of the project is 46 years. The EBITDA initially is $520 million per year, then $246 million for phase 1. This mine was discovered in 1975. LAC started exploration in 2007. In this location, lithium will be extracted from clay stone, using a complex process to break the stone down and pull out the lithium mineral. The company claims its process is much more environmentally friendly than that of other lithium miners. Lithium is extremely important since it powers laptops and phones, it is used in medications, and it's more needed than ever since lithium is used in electric vehicle batteries. All the big car companies say they will transition from fossil fuel cars to EV cars. The Biden administration wants to see lithium mined in a responsible way that respects the environment. The US government sees lithium as a source of job creation in Nevada because Nevada is home to the only large-scale lithium mine currently operating in the US. There are two lithium mines in Nevada facing legal challenges and pushback from conservationists. This creates an opportunity for LAC if its mining process is as clean as they say it is. The company is headquartered in Vancouver, British Columbia, Canada, and was founded in 2007. It trades on the New York Stock Exchange, TSX, and Deutsche Börse. Let's get started with the model. This is a mid-cap company, $3.9 billion market cap. They're trading at $33 a share, and they have 120 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they have negative free cash flow every year since they're pre-revenue. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's negative each year, except in 2019, they had a positive from the sale of assets. Revenue is the sales for the company, and they did have a little revenue in 2018, but it's been zero after that. This is the company's income statement. The top line is the revenue, the sales. So they're pre-revenue at this point. They do have some operating expenses because they're trying to move forward with the process and eventually start mining lithium. So they have negative operating income each year, and they have negative net income each year, except in 2019. They sold $77 million of assets. This is the company's income statement from their most recent quarterly report. This is the first 9 months of 2020 versus the first 9 months of 2021. And this gives us a lot more detail than Yahoo Finance. Their largest expense is exploration. It went from $13 million to $26 million. Here's a breakdown of that $26 million. $17 million from engineering, $5 million from consulting fees and payroll, $1.7 million to get the permits, and $1 million in drilling expenses. The next biggest expense is G&A. That went from $5 million to $7 million. General and administrative expenses, these are all the costs not directly tied to making the products. So it's the expenses of the day-to-day operations. It's a salary of support functions. It could also include rent. They gave their employees $3.2 million in stock. Last year was $4.2 million. They had to pass through a $2 million loss on the Argentina project and a $170,000 loss on Arena Minerals. These three are non-cash items, so we'll add them back on the statement of cash flows. LAC bought common shares and warrants on Arena Materials. You can look up the ticker. It trades on the TSX Venture, ticker AN. And the value of their investment went down, so they just mark it down on their income statement. But this is an unrealized loss, so they didn't lose any money until they sell the stock. You'll notice it's common for a company to buy stock in other companies, especially ones they do business with. They passed through a $4.7 million loss on Gemzy. Gemzy acquired an 8.5% interest in Minera XR. They acquired these shares from this company and Ganfeng. Ganfeng is the largest shareholder of LAC. This company, Ganfeng and Gemzy, they all own Minera XR. Minera XR holds the Cauchari project. That's this company's mine in Argentina. You'll notice when you try to dig into the financials how all these companies are intertwined. They spent $8.8 million in financing costs, and they received $5.3 million from financing income. Last year their net loss was $26 million, this year it's $46 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. And then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus capex gives you your free cash flow. And of course that's negative every year. So they're running their business on debt and equity. They issued $100 million of stock in 2020, $500 million in the trailing 12 months. When a company issues common stock, that increases the shares outstanding and makes your shares less valuable. And they also add debt every year, $18 million, $66 million, $37 million, and $50 million. But this is just what you have to do when you're pre-revenue. You need money from somewhere to continue running your business. This is their cash flow from operations section from the latest quarterly report, the first 9 months of 2020, the first 9 months of 2021. And the way you calculate CFO, you start with your net loss, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. We have to add back the $3.2 million of equity compensation, that's a non-cash item, $600,000 depreciation. We have to add back those losses we passed through on those two projects, $2 million from the Argentina project and $170,000 from Arena Minerals. We have to add back $4.7 million from Gemzy, and we passed through an unrealized gain, so we have to subtract that out here. And it looks like they're buying on credit, so when you use accounts payable, it's like taking a loan. So they use $2.7 million of accounts payable, that's a cash inflow. But when they pay for those products, it'll be a cash outflow. They reported a loss of $46 million, but actually leaked $37 million of cash flow. This is their cash flow from investing section, the first 9 months of 2020 and the first 9 months of 2021. They had a cash outflow of $53 million from a loan to XR. XR Capital provides financing to Minera XR, and that's for the purpose of developing their lithium mine in Argentina. XR Capital is a separate company, so they gave a loan to XR Capital, but that loan is going to benefit this company since XR is working on constructing their mine in Argentina. They invested another $1.6 million in their Cauchari mine. They bought $4.8 million of stock in Arena Minerals. They sold some assets, received $4 million. They invested in exploration of their mines, $1.3 million. You see CapEx, property, plant, and equipment, is on the bottom. If this was an American company, it would be on top, but this is a Canadian company. They had a cash outflow of $57 million in their investing section. And this bottom part is their financing section. They had a cash inflow of $400 million from issuing stock. They had to pay the investment bankers $23 million to help them issue that stock. That's about a 6% fee. And they drew down $50 million on credit facility, so they had a cash inflow of $427 million in their financing section. This is the equity section of their balance sheet. They have $527 million of equity. They raised $716 million from selling their business, and they lost $187 million from running their business. Let's look at the capital structure. They have $527 million of equity, $175 million of debt. They're 75% equity, 25% debt. Their net debt is negative $308 million, so they could pay off all the debt with the cash on their balance sheet and still have $308 million of cash left over. I gave them the lowest WACC on Finbox, 9.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $4.8 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $3.4 billion. We divide that by 120 million shares, and we get a calculated stock price of $29. They're trading at $33, so they're trading at a 15% premium. It's a sell according to the model. It's really difficult to value a company that's pre-revenue. I just assumed they would have negative free cash flow through 2023. And I gave them the highest negative from the past, negative 93 million in 22 and 23. And for the fourth quarter of 2021, I just divided the 93 million by 4. The way I got 320 million, the company said the mine in Argentina will generate 308 million of annual EBITDA. Earnings before interest, taxes, depreciation, and amortization. Since they own half the mine, I gave them 150 million. They own 100% of the mine in Nevada. They said initially the annual EBITDA will be 520 million. In phase 1, it'll be 246 million. So I took the 246 million to be conservative, plus the 150 million, that's 396 million, and then I reduced that 20% for taxes. So that's how I got their free cash flow for 2024. There's no guarantee they can extract the amount of lithium they say they can pull from those 2 mines. And there's no guarantee they'll pull any lithium at all. I just tried to use their numbers on somewhat of a conservative basis. Also, their revenue and profits are highly dependent on the price of lithium. If lithium skyrockets in price, they're going to make tons of money. And the stock might 5 or 10x. But if for some reason the price of lithium goes down, they're not going to make that much money. There's lots of moving parts to this, so it's really hard to value. Right now, it's all dependent on what the market feels. The price right now is based off of supply and demand of the market. Investors are looking towards the future. They see the importance of lithium, that's why they're willing to pay $33 for this stock, which equates to almost $4 billion of market value before the company has any revenue. 9 analysts priced this stock, and the average price target was 36, the low was 23, the high was 44. The demand for lithium is supposed to grow 900% from 2020 to 2030. If that does happen, this company can be huge. It could be worth $100 billion one day. The supply of lithium is expected to grow a lot, but not nearly as much as the demand for it. So if this graph is somewhat accurate, the price for lithium may be really high in 5-10 years. So you can see the stock has done really well the past year. It's pretty much only gone up. It did drop a little bit the first half of 2021, and just last week it hit its all-time high. The entire market has been regressing, so has this stock. The stock price is trading at $33 a share, which is higher than any point before October 2021. They have a beta of 1.51, so the stock moves 1.5 times the market. It's gone up 200% in the past 52 weeks, while the S&P is up 23%. The 52-week low was $9. The high was 42. The stock is trading above its 50-day and 200-day moving average. 5 to 6 million shares are traded each day on this stock. Of the 120 million shares outstanding, 93 million are on float. 24% are held by institutions, and 7.5% of the shares are shorted. Their employee count went up a lot from 2016 to 2018, but it's been coming down a bit since then. In the past year, one insider sold 90,000 shares, and he bought 5,000 shares. The public owns 59% of the company, institutions 18%, public companies 13%, hedge funds 5%, and insiders are 4%. Their biggest shareholder is Ganfeng at 12%. Ganfeng also owns half of their location in Argentina. The next biggest shareholder is Geologic Resource, then Dimension Capital, Van Eck, and Discovery Value. Let's look at their financial ratios. We can't look at the PE since they have negative net income. We can't look at the price of sales since they have no sales. Their price to book is decent at 7.5. They have a really high current ratio at 57. They have $480 million of cash on their balance sheet. So they do seem to have enough capital to get through the next few years. They had negative $46 million of free cash flow in the trailing 12 months, $476 million of working capital, so they have $431 million of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 11 companies in the same industry as LAC, And if LAC has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So obviously they don't have good ratios since they're pre-revenue. We can't look at their PE or price of sales. Their price to book and current ratio are better than average. They have a negative ROE, a little better than average in debt, and they're a lot smaller than the average company at $4 billion market cap, average is $32 billion. To summarize, I have them trading at a 15% premium. We all know with the importance of EV cars, lithium will be in high demand. The hard part is figuring out which company we want to invest in. This may be a good choice, but competition is inevitable. The only thing we can do is follow this company and see how their mines develop. I rank their free cash flows, revenue, and ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.